Okay, so you want to own a funeral home, a quiet building on a tree-lined street, a steady stream of families who need your services, and a business that, unlike almost every other industry on Earth, will never run out of customers. Death doesn't have a recession. It doesn't have a slow quarter. Every single person who is alive today is eventually a future customer. That's the pitch. That's why private equity firms have quietly bought up thousands of these buildings over the last 2 decades. Here's the problem. You are looking at the one certainty in this business that lies to you the most. Yes, everyone dies. But the money in this industry has almost nothing to do with that fact, and almost everything to do with a set of financial mechanics most people never think about until they're standing in a showroom, grieving, and being asked to make 8 decisions in 20 minutes. Let's start with what it costs to open the doors, because a funeral home is not just a chapel with some chairs in it. First, licensing. In nearly every state, you cannot simply hang a sign. You need a licensed funeral director, and in most states, that license requires a mortuary science degree, an apprenticeship of 1 to 2 years, and a state board exam. Some states also require you to personally hold an embalmer's license, which is a separate credential with its own coursework in anatomy, chemistry, and restorative art. Getting a single qualified person through that pipeline can take 3 to 4 years before they ever touch a body professionally. Now, the building itself. You need a preparation room, which is not a room you can improvise. It requires specific ventilation to handle embalming chemical fumes, drainage systems rated for biological fluid, and in many jurisdictions, a separate HVAC zone so those fumes never reach the areas where families sit. Retrofitting an existing building for this can run $150,000 to $400,000. Building one from scratch, with a chapel large enough for 100 to 200 mourners, a selection room for caskets, a reception area, and parking that satisfies local code, can push total construction costs past $2 million before you've held a single service. Then there's the part nobody budgets for correctly: the fleet. A funeral coach, what you'd call a hearse, costs $80,000 to $160,000 new, specially built on a modified Cadillac or Lincoln chassis. You need at least one, usually 2, because when one is in the shop, funerals do not pause to wait for it. Add a flower car, a family limousine, and a first-call vehicle for transporting the deceased from the place of death, and your rolling stock alone can run $300,000 to $600,000. Add refrigeration units for remains awaiting service, embalming equipment, and a casket showroom stocked with inventory you haven't sold yet. A modest independent funeral home can require $1.5 million to $4 million just to open before a single family walks through the door. Here's where the naive mental model breaks down. You think the money is in the funeral itself, the service, the flowers, the obituary. It isn't. The real financial engine of this industry sits somewhere almost nobody looks: the merchandise, markup, and increasingly something called the pre-need contract. Let's talk about caskets first, because this is the number that makes people uncomfortable once they understand it. A casket that a funeral home purchases wholesale from a manufacturer might cost the home anywhere from $500 to $2,500 depending on materials, whether it's cloth-covered particle board or solid hardwood or bronze. That same casket is frequently sold to a grieving family for $2,000 to $10,000. Markups of 300 to 500% are not unusual, and on premium models it can run higher. This isn't hidden or illegal. It's disclosed technically on something called the General Price List, which every funeral home in the United States is illegally required to provide under a Federal Trade Commission regulation known as the Funeral Rule, enacted in 1984. The Funeral Rule exists specifically because regulators found that grieving families, making decisions under emotional duress and time pressure, were a uniquely vulnerable consumer group, and that the industry had a long history of bundling services together so Families couldn't see, let alone question, individual prices. The rule requires itemized pricing. It requires that a family be allowed to buy a casket from a third party, an outside retailer, or even certain warehouse clubs. And the funeral home is legally barred from charging a handling fee for using an outside casket. Most families never know this option exists because nobody in a showroom is required to volunteer it. Now here's the psychology, and it's the same psychology that shows up in the gym industry and the mall industry, just aimed at a different vulnerability. A family typically has 24 to 72 hours to make a full slate of decisions: casket, vault, service type, flowers, obituary, transportation, all while in acute grief, often with several family members disagreeing, and often with a funeral director gently guiding the conversation from the least expensive option toward the middle or upper tier of the price list. This is not framed as a sales pitch, and to the director's credit, in most cases, it genuinely isn't experienced as one. But the structural incentive is real. The average traditional funeral with a viewing and burial in the United States costs between $7,000 and $12,000 once you add the vault, which most cemeteries require by policy, even though no law mandates it, plus cemetery costs, headstone, and incidentals. Cremation, by contrast, can be arranged for $1,000 to $3,000 in its simplest form. And this gap, roughly $10,000 between the cheapest dignified option and the traditional package, is where almost the entire profitability of an individual funeral home lives. And this is exactly why the single biggest structural threat to this industry isn't death rates falling. It's the opposite of what you'd expect: cremation. The cremation rate in the United States crossed 50% of all deaths for the first time in the early 2020s, and industry projections have it climbing past 60% within the decade. Every family that chooses cremation over traditional burial is choosing, on average, a service that generates roughly a third of the revenue. A funeral home that built its entire cost structure, staff, fleet, prep room, decades ago around a business where 80 or 90% of families bought the full traditional package is now watching that same building serve a customer base that increasingly wants the cheapest, fastest option available. The fixed costs of the building didn't shrink, the revenue per family did. This is why so many independent funeral homes have quietly leaned on a second business model that most families never think about at all: pre-need contracts. This is where a living person, often in their 60s, 70s, or 80s, prepays for their own funeral years, or decades in advance, locking in today's prices and sparing their family the decision-making burden later. On paper, this sounds purely wholesome, and for the family, it often is. For the funeral home, it's something else entirely. It's a financial product. The money paid today for a funeral that might not happen for 15 or 20 years has to go somewhere. And in most states, it's required by law to be placed into a trust account, or used to purchase a life insurance policy naming the funeral home as beneficiary. The funeral home doesn't get to spend that cash today. It has to let it sit, invested, growing, until the person dies and the service is actually performed. Here's the mechanic that makes this valuable. If the trust earns a reasonable rate of return over those 15 or 20 years, and funeral costs rise at a slower pace than the investment grows, the funeral home ends up performing a service in the future that costs less to deliver than the amount sitting in trust to pay for it. The spread between investment growth and cost inflation becomes quiet, compounding profit that shows up on the books decades after the contract was signed. A funeral home with a large book of pre-need contracts isn't really in the funeral business in the short term. It's running a small insurance and asset management operation with a funeral attached to the far end of it. But pre-need cuts both ways, and this is where a lot of independent operators get into trouble. If costs rise faster than the trust grows, if the home mismanages the invested funds, or if state regulation requires a larger reserve than the home anticipated, that locked-in contract from 1998 can become a money-losing obligation. The home is contractually required to honor at 2026 prices. Several major pre-need trust scandals over the decades, including cases where funeral home chains were found to have raided or mismanaged trust funds meant to cover future services, have led most states to tighten trust requirements considerably, requiring a higher percentage of the pre-need payment be placed in trust and subjected to regular state audits. Now let's talk about the structural event that reshaped this entire industry, because it explains almost everything about how funeral homes are owned today. For most of the 20th century, funeral homes were overwhelmingly small, family-owned businesses, often the same family running the same building for 3 or 4 generations, deeply embedded in their local community, trusted precisely because they weren't a faceless corporation. Starting in the 1970s and accelerating sharply through the 1990s and 2000s, a handful of large consolidators began buying these family businesses at a rapid pace. The largest of these, a company called Service Corporation International, grew to own or affiliate with well over 1,500 funeral homes and hundreds of cemeteries across North America. Here's the part that made this strategy so effective and so quietly controversial. These companies frequently kept the original family name on the sign. A family selling their business to a large consolidator would often sign a deal that let the building keep operating under the founder's name, sometimes for decades, while every financial decision, casket pricing, staffing, vendor contracts was now made by a public company headquartered somewhere else entirely. A family in town might drive past the same building their grandparents used, still bearing the same name, having no idea it hadn't been locally owned in 20 years. Why would the consolidators want this? Because the entire value proposition of buying dozens of local funeral homes is the same value proposition behind buying dozens of local gyms or dozens of regional malls. Centralize what can be centralized and preserve what can't. A large chain can negotiate casket prices directly with manufacturers at a fraction of what an independent pays wholesale, centralize accounting, insurance, and marketing across hundreds of locations, and spread the fixed cost of a call center or an embalming specialist across a whole regional cluster of homes. But it cannot centralize trust. A funeral home's entire value is built on being the place a family turns to at the worst moment of their life, and that trust is local, personal, and slow to build. So the economics of consolidation only work if the corporate ownership stays invisible. The moment a family finds out their neighborhood funeral home is actually owned by a distant public company, and that the casket markup they're being shown reflects a corporate pricing strategy rather than a family's judgment, the entire trust relationship the business depends on can crack. This tension came to a head publicly when journalists and consumer advocates in multiple states began documenting cases where families discovered, sometimes only after the fact, that the small hometown funeral home they'd chosen specifically because it wasn't corporate was in fact part of a large chain. Several state attorneys general have pursued cases against major funeral corporations over pricing transparency and pre-need trust practices. And disclosure requirements around corporate ownership have tightened in a number of states as a direct result. So how does an individual funeral home actually make money in plain mechanical terms? The core engine looks like this: fixed costs, building, fleet, licensed staff, insurance, utilities, typically run $40,000 to $80,000 a month for a mid-sized independent operation. Against that, average revenue per traditional funeral runs $7,000 to $12,000, and average revenue per cremation service runs $2,000 to $4,000. If a home handles 150 calls a year with a mix of 55% traditional and 45% cremation, blended average revenue per call lands somewhere around $6,500. That gets you to roughly $975,000 in annual revenue. Subtract cost of goods, caskets, urns, vaults, typically 25 to 35% of revenue. Subtract fixed operating costs, and a well-run independent home nets somewhere between 10 and 20%, translating to an owner take-home of $100,000 to $190,000 a year on that call volume. That's the optimistic scenario, built on a call volume that took decades of community reputation to establish. Here's the realistic scenario, and it's the one quietly squeezing independents across the country right now. Cremation rates in your market run higher than the national average, common in the Pacific Northwest and parts of the Mountain West, where rates already exceed 70%. Your blended revenue per call drops toward $4,500. A large chain-owned competitor 2 towns over, backed by centralized purchasing power, can afford to run a discount cremation-only location advertising services at $1,200, well below what your fixed cost structure allows you to profitably match. Meanwhile, your building, designed decades ago around embalming and viewing rooms nobody uses as often anymore, still has to be heated, insured, and maintained at full size. Under those conditions, that same 150-call operation can slide from a comfortable double-digit margin into break-even or a loss, even while the parking lot still fills up for services most weeks. The building didn't get less busy. The revenue per visit simply changed underneath it. This is the single most important idea in the entire death care industry, and it's the one that connects every thread we've walked through. It was never really a business built on demand, because demand, tragically, is guaranteed and permanent. It's a business built on margin per family, and that margin is being quietly compressed from 2 directions at once. Rising cremation adoption on one side, and corporate consolidation squeezing independent pricing power on the other. The families walking through the door will never stop coming. The only question that determines whether the business survives is whether what happens after they walk in still generates enough to keep the lights on.